What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. We're going to continue on with just overall earnings recaps, my thoughts on particular companies' earnings in this video. And this week, we are going to go over Dollarama, who just reported earnings this morning. And this company, over the last while, has been absolutely killing it. There is no question about it. It has been one of the premier dollar store operators in North America and even globally, and it just continues to put up outstanding results. Before we start the video, as always, make sure to like the video, head down below, subscribe to the channel, and let me know what stock you want me to look over next in the comments. And as always, there is a link to Stocktrades Premium where you can view all of my research, my portfolio, my ads, my sells, my returns, all that type of stuff. I've left a link in the description if you want to join the platform. So Dollarama reported its 2025 second quarter results. So this is one of those companies that's kind of in a fiscal year that is ahead of everything else. This gets a little bit confusing. So yeah, fiscal 2025 second quarter results. So on a earnings basis, they reported a 18.6% increase in diluted earnings per share. And that came in at $1.02, whereas estimates were predicting around 96.8 cents. So they did top estimates in this regard. And when we look to sales, they came in at $1.563 billion. When we look to estimates, we're looking at $1.57 billion. So this was effectively right in line with analyst estimates. It would have missed by around $7 million. That's going to be pretty much a non-factor, especially considering the overall growth of this company over the last bit. When we look to comparable sales, which are effectively comparing stores that existed 1 year ago today to the same stores that existed today. So what this does is this isolates out acquisition or new store growth to give you a better idea of, how the, overall stores are growing organically. You don't really want a company that is purely growing through acquisitions or new store additions, because ultimately when those new store additions or those acquisitions stop, the growth disappears, and it's a lot more capital intensive way to grow the business. So comparable store sales effectively measure the internal growth of the stores that existed 1 year ago today, that existed today. And on that front, they grew 4.7%, which is relatively strong. When we see total sales, they increased by 7.4%. So you're seeing some strong organic growth from Dollarama, but you're also seeing some strong growth in terms of new store additions. Now, EBITDA came in at $524.3 million. That increased by 14.7% on a year-over-year basis. And we now have EBITDA margins of 33.5% compared to 31.4%. So not only is growth increasing, but this company continues to increase margins. It is continuing to become more and more efficient. And when we look to operating margins, in my opinion, one of the most important margins out of all of them, we can see that operating income increased by 15.3%, sits at $422.9 million, but this represents an operating margin of 27% compared to 25.2%. So I want to go over one thing in terms of margins for Dollarama. We can see over here in Y charts in the bottom, we got operating margins of 24.35%, which obviously will be adjusted up for their most recent quarter. We have gross margins of 44.74%. And on, $5.9 billion in revenue, we have around $1.25 billion in trailing 12-month cash flow. Now, when we look to a company like Dollar Tree, we can see that operating margins are effectively break even. They're not even close, and gross margins are around 14% lower. And we can look at, for Dollar Tree, which is one of, at least here in Canada, I mean, Dollarama and Dollar Tree, they're often very close to each other. They are main competitors, I would believe, in Canada. We don't have too many dollar store options, but we do have some, and Dollar Tree is certainly one of them. We can look at revenue of $31 billion and free cash flow of $460 million. So this is so important to highlight how key it is for a company to have strong margins and just be effective operationally. I mean, we're looking at Dollar Tree has what, 6 times the revenue, but is generating 1/3 of the free cash flow, and the operating margins are practically non-existent. And when we look to a company like Dollar General, which I know Dollar General is not really the same product mix as a company like Dollar Tree. They're not like a pure dollar store operator, but even here we can look at, revenue of $39.68 billion. We can see free cash flows of $1.69 billion. So slightly better free cash flow generation than Dollarama on 7 times the revenue, the annual revenue generated by Dollarama. We look again, gross profit margins aren't even close to Dollarama. Operating margins, not even close. So Dollarama is, in my opinion, the best operated dollar store in North America. So they opened 14 new stores compared to 18 net new stores last year. So on a year-over-year basis, store openings are declining, but I don't really see that being a gigantic issue. And the company bought back 2.1 million common shares. Now, despite rising prices, Dollarama has been a big it's been buying back a ton of shares over the last 10 years. I mean, when we look to November 2014, we're looking at 394 million in shares outstanding. Fast forward to today, we're looking at 283 million, which would represent growth. They bought back 28% of their shares over the last 10 years. When we put this out to 5 years, it starts to be around 9%. And when we go down to 3 years, they bought back around, 4.7%. So this company is starting to buy back shares despite its share price being relatively high. So when we look to the results, one of the key things to look at here, and would be for a lot of retailers, is the number of transactions and the average ticket price of each transaction. So, as I mentioned, comparable store sales for the second quarter increased 4.7%. This consisted of a 7% increase in the number of transactions and a 2.2% decrease in the average transaction size, over and above comparable store sales growth of 15.5% in the corresponding period of the prior fiscal year. So pretty much what Dollarama is saying here is they had huge same-store sales growth at this point last year, and they're still able to grow on that huge increase, that 15.5% increase. They're still able to grow at 4.7%. And I know a lot of companies, they kind of write this stuff up to make it, seem good, make it seem better than it really is, make it seem like this, slowdown in growth is actually a benefit. But I actually do believe that this is, very strong. The fact that the company can report 15.5% same-store sales growth in the second quarter of fiscal 2024, which would have been, the third quarter of 2024, of calendar year 2023. Sorry, a bit confusing, I know. But the fact they're still able to grow on these numbers is truly a sign that consumers are shifting in a big way to go to, away from places like, let's say, on a grocer end, maybe something like Sobeys. On a retail end, maybe something even like Walmart. I mean, Dollarama does have, at least where I'm at, competitive prices to Walmart. I've even found myself shopping there, considering how, tight a lot of things are, how expensive things are getting. So, I mean, you're looking at a 7% increase in the number of transactions. That's big. And a 2.2% decrease in average transaction size. This is a bit surprising to me. I would have imagined we would have seen a higher average ticket cost because people are, spending more at Dollarama in a effort to save elsewhere. But this could be an element of, people are kind of choosing where they want to shop. They're picking and choosing particular deals. So they're reducing their average transaction size because they're kind of shopping around. Maybe instead of, pre-pandemic, they would have went to Walmart for every single item. Maybe now they're, going to Walmart for half the items that are cheaper, then they're heading to Dollarama for the other half that are cheaper. The one thing that is key here is there is a huge, huge shift in terms of consumers shifting to a cheaper, alternative over expensive retailers. Dollarama has been cruising for the better part of, what has it been here? If we look to their total price, it has been absolutely ripping ever since interest rates started rising. I mean, we look to during the pandemic, COVID-19 pandemic, I mean, Dollarama kind of struggled pre-pandemic as well, but it really didn't start kicking off until, the late 2020s, and it really started accelerating in, 2022 during that bear market when interest rates started rising, when Canadians started feeling that pinch. So one thing I want to go over is the company's outlook, and then I'm going to get into the valuation and whether I think it's still a, opportunity today. So we're looking at new store openings of 60 to 70 for fiscal 2025. Again, they're in their second quarter of fiscal 2025. And if we remember, they opened 14 new stores on the quarter. So this is, relatively in line with the bottom end of their guidance. In order to open 60 a year, you need on average around 50 a quarter. So this is, well within their range. Comparable store sales, they guided to 3.5 to 4.5%. As I've said, they're actually ahead of that this quarter. They sat at 4.7%, so very good sign. Gross margin, 44 to 45%. I believe gross margins actually came in higher than this. Yep, 45.2% of sales. So again, they're ahead of their gross margin guidance. Sales expenses, SG&A, sales and administrative expenses, 14.5% to 15% of their revenue. I'm not exactly sure what they reported for SG&A expenses during this quarter, but I would imagine, they've hit every other target, so I would imagine they're going to hit this one too. And capital expenditures, 175 to 200 million. The bulk of this is probably going to come from, new store expansion, building out their old stores, making them better, more efficient, things like that. And in turn, that CapEx should boost margins, should, increase the efficiency of the company. And actually, if we head down here, we can see the SG&A as a percent of sales. So yeah, we're seeing 13.6%. They are well ahead of this on the year. Through the first 6 months, they're 14.5%, still well ahead. We see capital expenditures of 100 million. That's guiding to the top end of their guidance. So by the looks of it, they are hitting absolutely everything they guided to on the year. They're killing it in terms of results. So many will ask, is Dollarama a buy today in my eyes? Now, I do believe the company is relatively expensive at this point. We're coming here, we're looking at a price to earnings ratio of 35.7x. That's on a trailing basis. I put very little weight into trailing earnings, except when I compare them to historical averages. It does give a relatively good indicator as to what the market has been willing to pay for a company like this over the last, 3, 5, 10 year. And when we look to this, the 3-year median average of around 30.4, 5-year around 29.4, and 10-year around 29.4. So when we look at this, Dollarama is trading at a near 20% premium in terms of what the market has typically paid for this company on a trailing earnings basis. Now, when we look to forward earnings, 29.43, this is still relatively high for a company that is growing at the pace that Dollarama is. This is a defensive retailer, so it's going to, often get a premium valuation relative to lower levels of growth. I mean, this company has earnings, forward earnings valuations that are equivalent to, US's big tech companies, despite the fact that it's not even growing at, it's growing at a similar pace, but not as high of a pace, yet it rewards it with the same, multiple. And this is primarily because the sector is so defensive. Sales are going to be so reliable, very steady, defensive retailers. They're going to command higher valuations. However, it is expensive at this point. I mean, when we look from a free cash flow basis, we can see 29.8x trailing cash flows. Typically, the market has paid anywhere from, over the last 10 years, 28.6, 5 years, 24, 3 years, 25. So the company does look expensive on that front as well. And when we look to PEG, 2.8, kind of highlighting that the market is more than pricing in the company's forward earnings growth over the next few years. And when we look to fiscal 2025 earnings, they're expected to come in at $4 per share, which would represent, relatively strong growth compared to 2023. But when we go out to 2026, which would be their calendar year 2025, remember they're a year ahead, we're looking at $4.49, which really only represents about 10 or 11% earnings growth. So the fact that this company is trading at, 20% 29x earnings, growing earnings at a 10% pace. It's very hard for me to justify paying that price for the company right now. However, it continues to just absolutely kill it. I mean, we're looking at 1 year targets, analyst targets of, about $135, which is effectively where the company is trading at right now. But it's up 5.5% on, strong earnings. The one thing that valuations never take into account is the company going and hitting more than expected, producing better than expected results. Ultimately, this is going to drive share price growth as the market adjusts those valuations. Would I buy Dollarama right now? No, I wouldn't. If I owned it, would I sell it? Absolutely not. It is a outstanding retailer. I can't see it slowing down in the current environment. I think that, the Canadian consumer is so weak right now. They're heading to a lot of, stores like Dollarama in order to, try to pinch pennies, save costs, try to survive financially. But do I believe that a lot of this is built into future earnings? Do I believe the market is already representing a lot of this growth, this expected growth, and, the lack of slowdown in terms of, Dollarama's sales? Yes. I mean, it just looks like that on a valuation front. It just seems a bit too expensive to me right now. Would I be buying? No. Would I be holding? Absolutely. And would I take any opportunity on short-term dips? Absolutely. Could there be a possible slowdown in Dollarama's price if rates continue to decelerate to the point where, Canadians have a bit more disposable income and they're willing to go back to, shopping at those more expensive retailers and maybe not, chasing deals and things like that? That's possible. And, as a result, we could see a dip in Dollarama's price. I mean, we're already down a bit off its all-time highs. We can see it was trading in the 137 range and we're back to 132. But overall, just outstanding company. It just, beats any other dollar store provider in North America by a wide margin, and just great company, just a touch too expensive for me at this point in time. So everybody, hope you liked the video. Head down below, subscribe to the channel, like the video, and if you want to see my full portfolio, all my moves, join our private Discord, get all of our stock research. Again, head down below. I'm going to drop a link to Stocktrades Premium in the description. You're not going to want to miss it. It is the best investment platform in the country, no questions asked. And everybody, stay tuned for more great Canadian investing content.